Hey everyone, thanks for joining. We'll give everyone just about a minute to trickle in, and then we'll go ahead and get started. While we're waiting for people to enter the webinar, I'm going to launch a poll question. If everyone could take a second to respond to it, that would be great. All right, I think we've given everybody a minute to enter, so why don't we go ahead and get started. The topic for the webinar today is empowering project managers with real-time financial analytics. Quick introductions. My name is Kevin Bright. I am the product manager with ProNovos, and joining me today is Brian Muncy with CBIZ. Brian, I'll let you give a quick introduction of yourself.
Yeah, I'm a senior manager with CBIZ-Somerset, work in the construction and A&E industry, working on both the assurance side, so that's the financial statement side, as well as the advisory side, and helping clients in this area, as well as other operational things that they can help improve on. So great to be here today, Kevin.
Nice. Yeah, it's great to have you. Brian's a very knowledgeable person, so we're fortunate to have him joining us on the webinar today. So yeah, let's go ahead and get started. So when we consider financial analysis for projects, I think the first place we always like to start with is the WIP. So Brian, I know you've probably seen a lot of different WIP schedules in your days. It's kind of more of a financial tool than it is a project manager tool. So I was curious if you give us kind of a brief background of how you see contractors leverage the WIP.
Yeah, I mean, this is the primary tool that upper management, your chief operating officers, your CFOs, your controllers, this is what they're going to do to start their initial analysis. They're going to use the information here that has your list of all your projects, and kind of get an idea of ones that may not fit their expectations that they'll end up drilling down to. So this is kind of their main go-to from an analytical financial side before they would drill down to other aspects within the work in process, the things that would drive the calculations for revenue and over and under billings.
Yeah, and I think that's a really good point, that it really is typically more the upper management that's utilizing the WIP, but it is really a great snapshot of what's the overall financial health of each individual project. So I think it can be a really powerful tool and a really good starting place for a project manager to look at as well, especially if as a project manager, you are looking at a lot of different projects, or if you have like half a dozen to a dozen projects, starting at the WIP, understanding which of your projects need kind of the most attention. It's a really good place to kind of start and get a little more analysis on your projects.
Yeah, because your working process is going to show your profit margin, job to date. It's going to show your revenue recognized, job to date, and it's going to give you an idea of how well you're doing from a billing standpoint. If from a billing standpoint you are billing up to that revenue recognized, and as well I've seen different formats of it. Most of them will at least have a job to date information, but some of them can have current year profit versus prior year profit, and then you can add in job borrow and other analytical information there as well, just to kind of be a high level review of jobs. Like you said, if you're managing several projects, you can kind of drill down to those ones that may have fluctuated month over month.
Yeah, I think that's a really important point to hit on. Is usually there's a lot of information on the WIP, right? Each contractor is going to have their own different version of the WIP. It can be a little overwhelming at first glance, but for my money, there's usually two KPIs on the whip I think every project manager should know. One is profit margin and the other is over under billings, right? So profit margin, how much money are we going to make on the job? That's why we do these projects. It's to make money. You know, it's good to be dialed in there. And then over under billings. I think this is a tricky concept for project managers, especially if they're new to it and they don't have a financial background. Maybe they're coming more from the operations side, but I think over under billings is one of the best early indicators if a project could be in trouble. And it's a really good bellwether of what is the cash flow on the project going to look like. So these two KPIs, profit margin and over under billing, I think they really get to two of the fundamental questions that every business has, including contractors. How much money are we going to make? And do we have cash in the bank to pay the bills? So we're going to spend a lot of time in this webinar kind of diving into the ins and outs of these two KPIs here.
Yeah, and I would say, you know, like whenever we do analytical analysis at the year end for like financial statement engagements, these are, you know, two of the key metrics that we primarily focus on because we typically know from history what your average profit margin is as a company. And so if we see deviations from that, those are the jobs that we're going to, you know, maybe dig a little deeper in and ask questions on. And then on the over under billings, like Kevin said, if you're significantly underbilled on a project, we want to know why, because it's sometimes an early indication of a job that's not doing as well as expected. Because, you know, why are you not billing that project? You know, there's got to be a rhyme or reason why. And sometimes there's a story behind it. I know we have some clients that work with departments of transportations and they kind of control the monthly billings a little bit more than on the private sector. So they, you know, they get behind on their billing sometimes, but they know that they're going to get it. Or you may have a project that bills on the 10th or 15th of a month, and it's a really active job. So by the time you get to the 30th of a month, you know, at the end of the month, it doesn't look as good because you've got 15 to 20 days of production that you haven't billed for yet. So there's sometimes there are reasons to have under billings, but it's good to understand those.
Yeah, I think that's really well said. So let's start to dive into each of these a little bit more. So let's start with the profit margin. And really the first place to start with profit margin is the project forecast. You know, to put it another way, what are my costs going to be to complete this project, right? That very first forecast you're going to do, it's going to be that initial estimate, that bid that you send to the client. That's going to be your original budget. That's kind of your benchmark for project forecasting. But then you want to make sure you're updating that project forecast throughout the project. And it's really important you're making these adjustments frequently so you can identify overruns early and take corrective action. I think we see this all the time in construction. Projects or specific activities run over. It's not because anyone's doing a bad job or anyone's incompetent. It's usually because something wasn't caught in time. That you're like, oh, shoot, I knew what the solution was here, but I just didn't realize it in time. So having that process where you're doing a routine analysis, comparing your cost versus your budget, and making those adjustments accordingly, it's a really simple way to make sure that you're on top of your jobs, your job costs, and nothing snowballs out of control. And what I would say is, as you're making those adjustments, what you really want to monitor is the overall profit fade or profit gain on the project. So if we look at this chart here, we can kind of see how our profit margin changes from one month to the next. And I think this is one of the best way to measure our project performance. It's not so much what's the total overall profit. Yes, that's really important, but it's really a question of how much profit are we going to make compared to what our expectations were. And being able to identify that fade and gain on a consistent basis really shows that you have a good handle on your project. Quite frankly, you don't want to see a project like this where your profit margin is ping-ponging up and down, right? That's a clear sign that, like, hey, if I'm having to make these radical swings and adjustments every month, I don't really have a good handle of what's going on this project. So project forecasting is really a good place to start when kind of making sure you have accurate profit margins.
Yeah, I mean, it gets down to the sooner that you can identify, you know, issues on a project, and I know we don't want to look at only the negative side, but you know, the sooner you can identify there, then the more time you have to correct it. So, you know, you're going to have errors, you're going to have things that are missed, right? But the sooner we can identify those and come up with a corrective plan, then you're going to minimize that margin fade on that project. And then you got to think about, you know, the longevity of a project, right? If I have a short-term project, it's going to be harder to identify those quicker, but then it's going to be a learning environment where maybe the next time we don't make that same mistake. But if it's a longer project, maybe there's some things you can get creative with to make sure that you do what you can to regain some of that margin fade. So definitely an important thing to watch is looking at that forecasting of your project. And we'll get some other things of why forecasting is important as well as we kind of go through the presentation.
Yeah, and you hit on one thing there, that even on those short projects, maybe you can't make the adjustment, but there's still an opportunity to learn. And I think that's something else you want to do is when you're making these adjustments is you want to capture the root cause behind each of those adjustments. So then you can aggregate that data. And that's a really good way to establish a feedback loop to identify areas for improvement. So prior to my time at ProNovos, I was a project manager in construction myself, and I can't tell you the number of jobs I was involved in where we would get to the end of the job and be like, oh, we went over budget on XYZ activity. Why did that happen? And no one could really remember. So making sure you're capturing that root cause in real time really helps to make sure that you're taking the lessons from the current project and being able to continuously improve. So if I'm to look at my data here and I say, okay, I've got 100 grand in adjustments from missing material. Well, that tells me there's something in my purchasing department that I need to go kind of interrogate and say, okay, what can we be doing better here? And on the flip side of that, you don't just want to measure kind of the bad things. You want to measure the things that go right. So if you had cost savings because, you did something, a new design on this project, well, you want to record that, aggregate that, and know that. So if that design improvement can be used on future projects, you can make sure to incorporate it on future jobs as well. So doing that root cause analysis, making sure you're aggregating that data, it's a really good way to make sure you're continuously improving on your jobs.
Yeah, I think, that's one thing that's beneficial by aggregating all that is you kind of get that history. I think a lot of times people know right then and there what the mistakes are. They have a short-term idea of things that are going on. You try to make your corrections, but then whenever you reflect back, you don't really have all the details. So if you have something like this where you can both, quantitatively look at the numbers or even, from a qualitative look at how many of them there are, right? If you have something that maybe isn't that big of a dollar value, but there's several of them, then maybe there's something there from a process improvement or something that needs to happen. So I think having that aggregated data could be really beneficial in turning, change orders into, more of a learning process, also helping, the bottom line, turn it into possibly a profit center, but not having that information, we all kind of go through as you do, and then maybe you revert back or, you don't learn from it and then you make the mistake again. So I think aggregating that data is kind of a key thing if you're looking to continue to improve.
Yeah, and I think you again hit on something really important. You're looking at these adjustments, and maybe there was an opportunity to issue a change order that you didn't on some of these adjustments. And that's really the next place we need to consider when we think about profit margin on the job, right? So the project forecast, those are about internal budget adjustments, adjustments to the cost forecast. Change orders are the other side of the coin, right? If you think in the context of profit, revenue minus cost, change orders are updating that contract amount. It's answering that question of, hey, are we going to get paid if we do more work? And I think this is really the first place to start where you can see change orders cause unexpected profit fade. Are you doing more work and accruing more cost without a change order to pay for it? And you want to make sure you have a good way to capture all of that change order data to make sure nothing is slipping through the cracks. And generally speaking, I think this is something that project managers are pretty good at. But there's a second way that change orders can kind of lead to unexpected profit fade. And that is because typically in construction contracts, there is some language in there about what's the allowable markup you're allowed to put on contracts. Usually it's 10 or 15%. But if you have a project that's at a higher margin, so let's say you have a project at a 20% margin, but you can only put a 10% markup on your change orders, you're going to slowly see a little bit amount of profit fade for each change order you process. So having a chart like this where you can kind of measure as you're processing your change orders, what's happening to the profit margin on the project is really good. And to illustrate that point, we'll walk through kind of a quick example here. So if we consider this project, we have a $3 million contract. it's almost at a 33% profit margin. So really good job. I'm not sure if everyone on the call here has jobs with these healthy of a profit margin. But then if we consider we have a change order here for $125,000 at a 21% profit margin, when you consider how that, when you take into account that change order, the profit margin goes from a 32.8% profit margin to 32.3%. So almost a half point percent profit margin fade. And that may not seem like a huge deal, but if you do a lot of change order work, it can really start to add up. So here's, if we look at the entire list of approved change orders on the project, we can see most of these change orders were done at a lower profit margin, right? We see 11, 17%, 9%, 16, 11%. And by the end of the job, taking into account all of these change orders, that causes a profit fade on this project of 0.88% margin. And that equates to $27,000 in pure profit on this job. You know, that's not contract amount with costs associated with it. That's $27,000 of pure profit. So understanding this analysis of how your margin on your change orders may impact the overall margin on the project, it's a really important thing to be doing. And it's important not to only look at it for approved change orders, but also for those pending change orders. So you know, if you get some change orders approved in the next month or two, what's that going to do to your overall profit margin?
Yeah, I just will add, you know, a lot of times we talk with our clients and contractors about, you know, improvement or what things we can do, and we're like, what can we do just to improve margin by 1%? Well, and Kevin's example right here, he just shows you, like, you know, how change orders could lead to a 1% decline in that. So you know, I think one thing is just to, with what we're talking through here, is maybe having a realization of how much in change orders you have and maybe the impact that that has on your overall profit margin as a company, right? And then is there ways that, you know, we could take steps to improve that, so we're actually, you know, gaining on change orders as opposed to potentially, you know, not gaining, you know, fading on change orders. So, you know, having the information would maybe just give you insight onto, you know, where things you could improve to gain that 1% rather than losing it.
Yeah, and I think that's always an area that contractors can improve on. It's just that change order management. I mean, I think it's one of the more tedious parts of project management, but probably one of the most important parts as well. Okay, so if we consider how change orders tell us what that total contract amount is going to be, then the other thing we need to consider is how revenue is going to be recognized. I think this is one of more of the interesting quirks of construction financials, how revenue recognition is done. So Brian, this is something I know you have a lot of experience with, so I'll let you kind of walk through the nuts and bolts of revenue recognition.
Sure. So we kind of led in with the work in process schedule, and then the second concept was your you know, forecasting and being able to budget your cost, right? Well, that is a very key component of how the company recognizes revenue. Because as you can see on the screen here, we have your revenue is derived by taking your actual costs incurred job to date, and then comparing that to the actual costs you expect for the life of the job. And so whatever percent that calculates out to be is what you take time the contract value to determine the revenue that you're going to recognize. So that's why whenever we kind of talked initially about, you know, project, the forecasted costs and being able to forecast accurately, that's why that's such an important metric, is because that's what's driving the revenue recognition on the financial statements.
Yeah, and we're actually going to go through an example of what happens here if you don't have an accurate projected final cost. So let's take a look at an example here. So we're going to look at a project here that has a $2 million contract amount, very healthy job. It has a 28.5% profit margin, was the initial profit margin. And then through the course of the project, we actually saw that profit margin increase to almost 34%. So really great job, really healthy, strong profit across the board. But what ends up happening is if we look at kind of the profit distribution by month, we see this dip in April 2017. So what happened here, right? If you have a project that is this profitable, you should never see a month with a negative profit on the job. So let's dig into the data and see how that happened. And what we're going to see is in April 2017, my projected final cost increased by almost $120,000. So remember, our percent complete is job cost divided by projected final cost. So if I increase my projected final cost, the denominator in that equation, my percent complete goes down. And I can see that here, right? In March, I had a 96.5% complete. And then in April, with my new projected final cost, it goes down to 89.2%. So this creates a problem because I recognize my revenue by percent complete. So in March, when I said I was 96.5% complete, I overstated my revenue, which means in April, I need to record a negative revenue. So my revenue to date in April is in line with that new 89% complete. And again, that's what we see here, right? 96.5% complete of my $2 million contract in March. That means I've got a revenue of $2,025,000. In April, it's now only 89.2%. So my revenue is actually 1.871 million. So my revenue's gone down $150,000 in April, but that doesn't mean my costs go down. I still have my normal job cost in April. So I've got $12,000 in cost. So this means that I'm going to record a negative profit of $166,000 in April. So this is why having an accurate project forecast is really important throughout, because if you don't have that accurate forecast, you're going to over earn the job early in the project, and then you have to write it down at the end. And I can tell you from experience, this was one of the biggest pet peeves my CEO used to have when I was a project manager. Is I'd have, a great job, and then at the end I'd be like, oh, hey, by the way, we had some unexpected costs. We need to increase the projected final cost by $20,000 at the 11th hour. And it would drive him up a wall because it's of this right here. You're seeing that unexpected profit fade at the very end, and you're having to record that as a pure loss in that period.
Yeah, I mean, you hit it right on the head, Kevin. I mean, you typically want to, do your best job at projecting your final cost, and then that's going to prevent you from having that fade as best you can. We all know that sometimes jobs take on legs at the end and they go on, but you should be able to try and conservatively do that. I mean, whenever we look at financials, we always like to see that there's a consistency there in profit margin and not significant swings. Whenever we see large deviations from the average margin, both plus and minus, that raises questions of what's going on with that job. Why is it different? We've kind of got up here on the screen. Other users of the financial statements, would be your bank and your bonding companies. They're going to do a spread of your jobs and kind of have an idea what your average margins are. They're going to compare, where you budgeted a job that was still open at the end of a year to where it completed in the following year. And then if there's significant swings, they're going to want to have an understanding of that. That's kind of the same process that we do. We kind of look and get a history of like what your margins are and try to, look and analyze the information to see, if they fit within those expectations. So that's why your forecasts are such an important thing, because they drive that, revenue. And, the banking and bonding, if you show favorable adjustments, so basically what we're saying there is if you're showing margin gains, toward the end of projects, compared to where it was, that's going to look more favorable than showing margin fades toward the end, because that just basically is letting the reader, the financial know, or the ones that analyze the information know that you're able to accurately estimate your projects.
Yeah, and I think this is a really important thing that I know personally. When I was a project manager, I didn't fully understand how much external stakeholders are looking at, the project financials. You're so in the weeds of it. You're just kind of so dialed into how the project financials are impacting the internal. But when those external stakeholders are looking at it, they're really assessing, hey, how risky is this contractor in terms of performing? So it's really important not only to make sure your jobs are performing, but it also has a larger impact in terms of how risky the company is assessed as. So there's one last implication to this. This means that when you forecast your revenue, you need to forecast basically your percent complete, or perhaps more accurately, your cost per month. This is something we've experienced that project managers really struggle to do accurately. there's just a lot of variables to consider on a project. And what we always recommend is rather than trying to go and forecast it to the penny by each month, it's better just to use kind of a standard curve. And then you can kind of measure against that. Hey, are you following the normal trajectory or not? So usually the most common curve we see on construction jobs is an S curve. It reflects that kind of slow ramp up, peak in activity, and then slow ramp down that you often see on construction sites. So that's just one other thing to keep in mind. But now
Yeah, I
that we've
was
kind
just
of,
going to go back and say,
yeah,
just real fast. Revenue forecast is going to be driven based on your costs, as we just kind of talked about, right? So if we have a good idea of our costs and we can project our cost, then we're going to be able to forecast our revenue because it should kind of flow. Um, so anyway, just want to, that's why we were kind of mentioning cost and things like that to begin with, because that's going to help you with that revenue forecast.
yeah, and I guess we should spend a little bit more time here. I think that's an important note to make because typically, again, going back to my experience as a project manager, when I was forecasting cost, I didn't necessarily understand that, hey, when the CFO or the CEO is putting together their revenue forecast for the year, they're basically folding in what your cost forecasts are on the project because that's what's driving the revenue. So
Yeah.
again, understanding how that cost forecast is impacting the larger company revenue forecast, it's a really important thing to make sure you're paying attention to.
Yep.
Okay, so we kind of covered the profit margin side of it, the revenue. Now I think we'll kind of pivot and talk about over under billings. So this is like we talked about, I think one of the more tricky things in construction is understanding revenue does not equal billings. Over billings are going to be when your billings are greater than your revenue. Under billings when your billings are less than your revenue. I won't speak for all controllers, CPAs, CFOs out there, but I can say with a high level of confidence that if you ask them, 99.999% of them are going to say that you always want to be overbilled on a project to make sure that you're staying cash flow positive on a project.
Yep. You're right on. We've taught you well, Kevin.
So I think it's important to kind of consider why it's important to be overbilled on a project. And it's really because cash flow, it's a nightmare in construction, right? I think anyone that's been in the construction industry understands how difficult cash flow is. And what we're going to look at here is an example. So on this project here, we were able to bill $150,000 in the first month before we even had a single dollar of cost. Now, there's a couple things to note on this curve here where we look at our billed versus cash versus our cost. What I can see is even though I billed $150,000 in May, it was almost 3 months before I actually got paid for that in August 2022. And the second thing to note here is even though my billings consistently outpaced my cost, it wasn't until May 2023, almost a full year later, that my cash received actually consistently exceeded my cost. So it can be really challenging to get cash flow positive on a project. And I always recommend that project managers are looking at a chart like this, comparing the build versus the cash versus the cost, because it really does a good job of illustrating, okay, where do we stand from a cash flow perspective on this specific project?
Yep, I agree.
So if we think about why it's so hard to be cash flow positive on a construction job, there's really two main factors. The first one is slow payment. So if we look at the average days to pay for this job, we see it's about 92 days. That's a bit extreme. Typically, we see this closer to 60 days. But having a chart like this where you can see the individual payment days for each invoice and then the average days to pay, it's a really good tool to have because it's going to do two things. One, it kind of gives you information so you can manage the job appropriately. And then two, it helps you negotiate payment, right? Having this data available when you go to your client and say, hey, you're behind on your payments. It's taking you on average 92 days to pay. It's just a nice kind of arrow to have in your quiver to help kind of negotiate a quicker payment. And then the second reason that cash flow is so difficult is retention, right? You're just kind of starting the whole 10% every project. That can be really challenging. So the combination of those two things really make cash flow difficult on construction jobs.
Yep, we've included a couple
yeah.
tips here. One is, the best you can sometimes front loading your schedule of values. So that way you're getting more of that cash up front, being aggressive on your billings, kind of as we just talked with that last graph, being as aggressive as you can, as much as the customer will allow you. And then a last one that, just to make sure, a lot of people do this, but just making people aware, is seeing if you can get a provision in your contract that says once we're 50% complete, can we reduce the retention from 10% to 5% or whatever that percentage is, cut it in half. Then you're getting half of that retention, halfway through the job, which can help. So we're just kind of pointing out that some of these tools will help both from a billing standpoint, understanding the impacts to the financials and how they impact the job, but then also looking at, how it impacts the cash flow. You always want to be, cash positive if you can, because then you're using the customer's cash as opposed to the working capital and cash of the business. So we won't have to borrow on, our line of credit, won't have to borrow on our debt. You can see here with being at 92 days, average days to pay, if we're paying out some cost, with maybe 30 to 45 day terms, payrolls, 2 weeks, we're paying out a lot of costs before we're getting that cash back in the door. So cash flow can oftentimes be challenging. But these tools, these analysis and things like that can help everybody in, increasing the cash flow of the business.
Yeah, and we're coming up on time here, so we'll
Yep.
wrap up. And here's where I'll make my shameless plug. All the visualizations you saw today, these were powered by ProNovos's tools. So ProNovos, it's a construction financial intelligence platform. What we do is we connect to your accounting system. We pull all the data into ProNovos. All the visuals you saw, they would be automatically created. You don't have to do anything. We populate that data for you. So yeah, thank you everybody for joining today. We will hang on for about 5 minutes in case anybody has any questions. Feel free to drop it in the Q&A, and Brian and I can stay on for a couple of minutes to respond to them.
Yep. Thanks, Kevin. Thanks everybody for attending.
So first question, will we receive a copy of the slides and a recording to share with the others? Yes, once the webinar is finished, a link will be distributed with a download version of the recording. Second question is, let me do one more thing real quick, sorry. Sorry, before I'm going to launch a poll question, see if anyone just would like to see a demo of ProNovos. But I'm sorry, next question. Does ProNovos create all of these visuals you've shown and put in project manager's hands? Yep, so that's what we do. We'll, like I said, we'll connect to your accounting system, pull the data. We pull the data nightly. All these visuals get automatically created. I think those are all the questions I see. So unless anybody else has any last questions, we can wrap it here. Brian, thank you again for joining today. It's always great to get your expertise and your thoughts on how project managers can be using some financial analytics.
Yeah, thanks, Kevin. Appreciate it, and look forward to continuing to work with you.
Thanks. Real quick, I guess I see one more question here. Will this system work with Foundation? Yes, Foundation is one system that we connect with. All right, everybody, thank you for joining. Hope you learned something about how project managers can leverage financial analytics. Thanks.